Hi everyone, this is Stephen, and I'd like to welcome you back to our second technical analysis video on market trends. So let's go ahead and jump right into it. There are three kinds of market trends that we're going to talk about today. The first trend is the uptrend or bull market. And this is a move upward in a market over a fairly extended period of time. In a bull market, each peak and trough is higher than the previous one. What that means is each movement up followed by a subsequent movement down is higher than the previous movement up and movement down. Bull markets are generally less volatile than bear markets. It's not always the case, but usually. And the movement in a bull market is usually slower when compared to a bear market. A downtrend or bear market is when a market moves down over an extended period of time. In this case, each peak and trough is lower than the previous one. Bear markets tend to be more volatile than bull markets, and they also tend to happen more quickly than a bull market. And we'll see that in a couple of charts that we'll look at in just a minute. Finally, the third type of market trend is a sideways or consolidating market. In this case, a stock or a market is moving in a range between two price levels. A consolidation can be a trend unto itself. You can have a consolidating market that consolidates for years, or you can have a consolidation movement within a bear or bull market. So you'll have a strong move up and then a consolidation for some amount of time where the market moves sideways, and then you'll have another move up. Or you could have the opposite in a bear market where the market's moving down, then you have a sideways movement for some amount of time, and then you'll have a continuation of the bear market. Before we look at a few charts, let's talk for just a second about why we care if we're in an uptrend, a downtrend, or a sideways market when we are trading using technical analysis. When using technical analysis, we're looking for the story behind the price movement in the stock up to this point, and we're trying to determine where the stock is headed from there. So we want to look at the various factors surrounding the stock, the price, the volume, how quickly the stock is moving up or down. And one of the factors that we want to consider is whether or not the market and or the stock is in an uptrend or a downtrend. If we want to trade long the stock, then we prefer a stock or a market that's in an uptrend. And if we want to short a stock, we prefer a market or a stock that's in a downtrend. If we're trading a range-bound stock, then we know where to put our buy orders and our sell orders depending on where the stock is within the range. If it's at the lower end of the range, we'll be looking to buy more. And if it's the higher end of the range, we'll be looking to do more sell trading. And that's why knowing where the general market is headed, as well as knowing where your stock is headed, is important in technical analysis. Now let's take a look at a bull market and two bear markets that have taken place in the last 18 years. The first chart we're going to look at is the S&P 500. The S&P 500 has been in a bull market since March of 2009. If you look at the lower left corner, you can see the beginning of the bull market. As I said, here in March 2009, you'll see the market steadily climb until May 2010, and then you see a slight pullback. As we were talking about before, the market peaked in May 2010, pulled back to a slight trough in July 2010, and then headed back up. You'll see another peak in May 2011, and then a pullback to a trough in October of 2011. But as you'll note, the trough in October 2011 was higher than the trough in July of 2010. So the bull market remained intact. The market climbs again and then peaks in April 2012, which you'll note is higher than the peak in May of 2011. And then you'll see a slight trough in June of 2012, but again higher than the trough set in October of 2011. So again, the bull market is still intact. And you'll see the market steadily climbed up through January of 2015, and then pulled back the bottom of the trough is January 2016 before climbing again. And again, this trough is clearly much higher than the trough set back in June of 2012. The market starts moving higher again, and we get to where we are today in August of 2018, and the bull market is still intact. One thing I want you to notice in this bull market is the size of the candlesticks. Each one of these candlesticks represents a month, and you'll note that there has been a fairly orderly progression to the upside in this market. You don't see a lot of volatility. There is some in the 2015 to mid-2017 time period where you'll have these larger candlesticks. But generally, a bull market is pretty tight. The candlesticks, there's not a lot of range. It's just a continual march to the upside. And I want you to notice the contrast between that and the bear market that we're going to look at now. So let's now take a look at two bear markets that occurred in 2000, between the year 2000 and 2009. The first bear market started in September of 2000. You'll see that the market tops here at 153.59, and this bear market ended with the market being down 50% in October of 2002. A couple of things I'd like to point out. First is how quickly the bear market took the S&P down 50%. It was only 2 years between the beginning of the bear market and the end of the bear market that the market was down 50%. Before that, the market had been climbing for several years in a bull market. You'll see this again as the market began a bull move in October of 2002. For 5 years, we had a bull market up until October of 2007. And at that point, the market turned bearish. And you can see the really sharp declines. I was talking about volatility before and how it's not that great in a bull market generally. But you can see on these monthly declines, there's a really sharp decline in the market. And in this case, this bear market ended with a 57% decline from peak to trough. So let's zoom out now so that we can see both the bear and the bull markets that we've talked about. And you can see the contrast between the very sharp decline, especially in this bear market, but you can also see it over here, and the less volatility, especially after 2012 in this bull market. Again, there was a slight uptick in volatility here, but it's nothing like the volatility that we saw in August of 08 and October of 08 timeframes. As we were talking before about the importance of knowing what type of market you're in when you're trading, you wouldn't want to be long very often in a market that's dropping 50% or in a market that's dropping 57% in 2 years. But if you see a chart like this, where the market is steadily moving up, then most of your trades are going to be to the long side. What the market chart does is give you a big picture frame to begin your analysis with, and then you can go into some of the analytical frameworks that we'll be talking about in later videos. So that's market trends. Thank you for watching, and we'll see you next time when we'll talk about using different chart time frames for different trading styles. See you then.